Okay, good morning. In the interest of time, I think we're going to get started this morning. Thanks very much for being here. My name is Sarah Ladislaw. I direct the Energy and National Security Program here at CSIS. We are very, very pleased to be hosting the BP Energy Outlook 2016 edition today with Spencer Dale, who is the Group Chief Economist for BP. As many of you know, and the reason you've shown up this morning, BP has been long dedicated to putting out analysis, not only historical data, but forward-looking analysis on the energy trends that are shaping the oil and gas sector and the energy industry more broadly. Spencer and I were sort of talking with the group before coming down, and one of the ways he characterized some of what they do is to put some discipline behind the discussion of the energy trends that we're all sort of, opining on every day. And I think that's a real value to those of us in the think tank space and in industry and in the policymaking space to try and add some analytics and some quantification behind some of the things that we're talking about. And clearly, oil and gas markets are in an interesting place today. I think we probably say that every year, but they really are this year. And Spencer's going to help try and add some interesting thoughts about not only their base case, but and other additional scenarios that they've produced for this year, which include some of the overarching policy concerns about climate change and emissions, and economic concerns about slower rates of growth. Please, everybody, if you could turn your phones off. And in addition, we don't expect any kind of incidents today. But if there were some sort of an emergency, we take safety very seriously here at CSIS. Please go out this back door or over to the side of the elevators to the emergency stairwell. It'll take you out to a back alley, and you can find a piece of grass to be on. But we don't anticipate that happening. So, without further ado, Spencer, it's really great to have you back here at CSIS, and take it away.
Thank you very much. Thank you, Sarah, and good morning, everyone. Thank you all so much for sparing the time to come out this morning. A personal thing, I worked, in my old life as in central banking, I worked for 2 years at the Federal Reserve between 2006 and 2008, and by far and away, Washington is my favorite city, so I'm always so pleased to come back because I just love Washington. Normally because it's always like this, summer or sometimes it's hot, sometimes it's cold, but it seems to be always, the sun's always shining. And for somebody who comes from London, that's a really lovely thing. Thank you also to Sarah and CSIS for inviting me back. Sitting in London, you're very aware about the important role that CSIS plays in sort of shaping and informing the international debate on sort of global energy trends and many other things. So it's a real honour for me to be back, so thank you. And I was last here in June talking about BP's statistical outlook, statistical review of world energy, and the focus then was looking back over the last year and trying to understand what has been going on and some of the trends which were affecting markets over the last year. The focus today is far more ambitious. Rather than looking back 1 year, we're going to look ahead 20 years with the energy outlook. And the obvious point at this point is to say, what on earth are you doing? The markets are so uncertain, they're in such a state of flux. We can't even look forward 20 days, so how on earth can you look forward 20 years? And I think that's a perfectly sensible and legitimate question. Now, and one answer is, well, despite all the cutbacks and despite the reductions and issues that we're having within BP, for example, we're still going to invest something like $17 billion this year in long-term investments. We're going to make similar levels of investments next year. These are very long-term investments, so we've got to have some idea about what the world looks like. We can't just throw up our hands and say, I don't know. So that's one role. And the key thing for the energy outlook, why do we produce it? We produce it for ourselves, to help inform our decisions, and we produced this about a month ago and spent a month thinking about it, ruminating about it internally, and then if other people find it interesting, that's great, we come out and we can learn from talking to others about it, but initially this is for us. So part of it is to help us, and I think the other thing is there's a value in an exercise like the Energy Outlook, even in a world of such uncertainty, and the key point here is we don't kid ourselves that we have some great crystal ball, that we can see the answer into the future. Of course we can't. But we can do 2 or 3 things with something like the Energy Outlook where it can add value. And one of them is the point that Sarah's making about acting to provide some sort of discipline for the conversation. So I'm very struck nowadays that it is very easy to identify some of the key qualitative trends which are going to dominate energy markets over the next 20 years. So it seems pretty obvious to me that renewables energy are likely to grow very rapidly over the next 20 years. It also seems to me pretty clear that the growth in the demand for energy in China is likely to slow very sharply over the next 20 years as that economy rebalances. Identifying those qualitative trends is relatively easy. What I'm struck by, I often have conversations with people who identify those qualitative trends and then leap to quite extreme quantitative conclusions from that. So like the demand for energy will stop rising. There'll be no role for fossil fuels or any fuel other than renewables. And I think one of the real benefits of a framework like this energy outlook is it provides a sort of disciplining device to say, what are the quantitative implications of those qualitative trends? Do they point to a hard stop or just a point of inflection? And that's one of the things, I think, the role that it can play. The second role it can play is to help us think back about the past. How have events turned out from the past differently from what we expected? And what signals should we take from that for the future? One of the key, and your ability to look ahead is often really helped by knowing where you've come from and how to interpret what you've come from. And the Energy Outlook provides a disciplining device, again, to sort of challenge your preconceptions, to say, look, we keep on getting surprised by this. There may be a sort of longer-term signal in that. How should we think about that? And the third way it can do that is, the third sort of way it can help our discussions is sort of framing the shape of the uncertainty we have going forward. The Energy Outlook is based around a most likely case, what we think is the most likely outcome for the world energy trends. And I think having a clear central case through which you can anchor the narrative is very helpful. But whatever you do, don't believe that most likely outcome is definitely going to occur. The probability of that occurring is almost zero. And so the whole point of it is it gives you a point of jump off to think about, if we relax this assumption or that key assumption, how does the world differ? And how does the outlook differ? And then we can start to shape that uncertainty around it. And so in the outlook I'll talk about today, and in the pamphlets and booklets you've got, it has elements of all three of those key bits. A clear base case, providing that quantification, lots of backward-looking analysis, understanding what we can learn from the past, and a series of alternative cases, thinking about what's helping us shape the uncertainty. And you'll be pleased to know, especially if you've got that fat book in front of you, you're thinking, oh my God, how long is it going to go on for? I'm not going to try and summarize all of that today. What I hope to do is just give you a taster, and then we'll throw it open for a question and answer session. But I hope that I'm going to pique your interest enough that if you are interested, you'll go away and read more about this in the actual outlook, because there's all sorts of, I think, fascinating issues raised in it. Okay, to set the scene, if you're doing any sort of outlook for energy, you need an economic backdrop. In our forecast, we have annual global GDP growth expected to average around 3.5% on a PPP basis over the outlook. That's just a touch softer than growth over the past 20 years and equates to GDP roughly doubling over the next 20 years. Some of that increase is driven by population growth, but the vast majority is driven by increases in productivity, shown here in those orange bars on the right, especially in emerging Asia, as those countries gradually build up capital and adopt best practice techniques from the rest of the world. So this, in terms of the economic backdrop, is a pretty conventional story of Asian tiger-led growth, with China and India accounting for almost half of that global growth. This doubling in the world economy causes the demand for energy to grow by around a third. Virtually all of this increase in energy is consumed by fast-growing emerging economies. Energy consumption in the OECD, which you can see by that green swathe on the left-hand side, on the left-hand panel, is essentially flat over the next 20 years. OECD economies continue to grow, but the efficiency with which they use that energy also improves, such that their net demand for energy is essentially flat. Growth in energy demand is projected to average just a touch below 1.5% per year over the outlook, which is quite a bit slower than growth over the past 20 years, reflecting both a sharp deceleration in China's energy demand, shown in that blue line, and I'll come back on the right-hand panel, and I'll come back and talk about that in a while, together with this sort of plateauing in energy consumption within the advanced economies. But an obvious question this poses about this growth of energy is can we really be sure that energy demand will keep increasing? Isn't this, some may argue, just big oil talking its own book? What drives energy demand? And the answer to that is very simple. It's economic growth. As the world economy expands, more energy is required to power the higher levels of economic activity, especially in emerging economies in Asia and Africa, where large parts of the population still don't have access to electricity. Plentiful supplies of energy enable economic growth, raising living standards and lifting people out of fuel poverty. The amount of additional energy required to fuel the global expansion is offset by reductions in energy intensity. So by energy intensity, what I mean is the average amount of energy needed to produce each unit of output. And in particular, we expect energy intensity over the outlook to fall more quickly than in recent history. So increasingly less energy is needed to produce the same amount of activity. That reflects both a continuing rebalancing of the Chinese economy away from very energy-intensive activities, and more generally, worldwide efforts to improve energy efficiency post-Paris. And the impact of falling energy intensity is illustrated really clearly in this left-hand panel here. Global GDP, shown by the red line, more than doubles, but energy demand increases by only a third. The widening wedge between the two reflects the impact of declining energy intensity. But even with this rapid improvement in energy intensity, energy demand still increases by a material amount over the outlook. So how could that be wrong? How could that basic conclusion about this material growth in energy demand over the next 20 years be wrong? The chart on the left, in some sense, provides a natural way of thinking about how it could be wrong. It can be wrong in one of two ways. First, if global GDP grows more slowly than expected, so the red line increases by less than we think, or alternatively, if energy intensity falls even more quickly than projected, causing an even bigger wedge between GDP and energy demand to open up. And in some sense, in terms of that left line, in terms of that left-hand panel, they are the two things, the only two things which can cause the growth of energy demand, that purple line, to be slower. Either the red line, either GDP grows by less, or the energy intensity declines by more, widening that wedge. And both of those possibilities pose risks to the outlook. To explore the first risk, the possibility of slower global GDP growth, we consider an alternative case in the outlook in which China is assumed to grow more slowly than we expect in our base case. In particular, we construct a scenario in which annual Chinese GDP growth averages just 3.5% over the outlook, rather than the 5% growth assumed in the base case. Taking account of the implications of this slower Chinese growth for the rest of the world leads to global GDP growth of a little below 3% a year. So that's about half a percentage point slower than in the base case, which, as you can see from the right-hand chart, if you sort of let your eye follow that dotted line across to the right-hand chart, that would be comparable to one of the weakest periods of economic growth seen in recent history. Energy demand in this alternative case, shown in purple, is projected to grow by just 1% per year, as you can see, which is weaker than at any point in recent history, and around a third slower than in the base case. But even in this alternative case, energy demand still increases by almost 25% by 2035. Significantly less than in the base case, sure, but still a marked increase. But what about the second possibility? So even if GDP growth comes through, what about the second possibility that energy intensity may fall even more quickly than in the base case? As I mentioned, the projected pace of improvement in energy intensity in the base case, shown here in purple, is significantly quicker than seen in history. The green bar on the top of the left-hand panel here shows the average pace of decline since 1965, and the red bar, the quickest pace of improvement in any 20-year period over that time. So you can see that we're building in far greater declines in energy intensity seen at any point in the past. So given that, a simple reading of history might suggest that perhaps the risk to energy intensity, if anything, skews towards a slower rate of decline, which other things equal would point to even stronger energy demand. But of course, history may not be a good guide to the future. In particular, the changing structure of the world economy, together with pledges made at Paris, mean that energy intensity is likely to fall more quickly than in the past, which are exactly the types of judgments that we build into the base case and exactly why we have it falling more quickly than in the past. But as shown by the yellow bar here, for energy intensity to fall sufficiently quickly to offset any increase in energy demand, it would need to decline at more than double the rate seen over the past 20 years, which seems highly unlikely. So to return to the question I posed, what drives energy demand? The simple answer is the increasing need for energy as the fast-growing populations of the world grow and prosper. Increases in energy enable that growth. Rapid declines in energy intensity are likely to limit the required increase in energy, and the extent of the increase will be highly dependent on the strength of global growth. But my conclusions after working through this was, unless the world economy grows far more slowly than most commentators expect, we are likely to see a marked increase in the demand for energy over the next 20 years. And in some sense, that's my first sort of takeaway from this year's energy outlook. In terms of the fuels meeting this increased demand, the outlook points to a significant shift in the mix over the next 20 years. Fossil fuels remain the dominant source of energy powering the global economy, providing around 60% of the increased energy. And remember that 60% number, because I'm going to come back to it at the end. Okay, so in this story, in our base case, fossil fuels providing around 60% of the increased energy and accounting for almost 80% of the world's total energy supplies by 2035. Gas is the fastest growing fossil fuel, overtaking coal as the second largest fuel source by the end of the outlook. We can see here on the left. Oil grows steadily, although the secular decline in its share continues. In contrast, coal suffers a sharp reversal of fortune, with its growth slowing to just 0.5%, which is less than a fifth of the rate seen over the past 15 years, and its share within primary energy declining to its lowest on record. And the big driver of that is what's happening in China, and I'll come back to that. Renewables, shown by the orange line, are the fastest growing fuel source, with their volume almost quadrupling and their share within primary energy increasing from around 3% today to 9% by 2035. And if you like, this renewables is one of those examples of qualitative trends and quantitative implications. Renewables here are growing by around over 6.5% per year each year. So if any of you know of a financial bond that will give me 6.5% return each year for the next 20 years, please let me know afterwards. I'll be very happy to invest in that. If you do, your money will almost quadruple over that period, which is what your renewables are doing. But they're still, despite that extraordinary period of strong growth, they still provide less than 10% of the world's energy needs by 2035. Just one of those stories of thinking about how qualitative things add up to quantitative implications. These projected shifts in the global fuel mix reflect a myriad of factors, but there are perhaps four key issues in particular worth highlighting. One issue is the outlook for carbon emissions, and I'm going to come to that later. The other three the prospects for shale oil and gas with a key sub-theme of what have we learnt about the US shale revolution, China's changing energy needs as its economy continues to rebalance, and the prospects for renewables and other non-fossil fuels more generally. And my plan is to say a little about each of these three, starting first with US shale. So this pair of charts show forecasts for US tight oil and shale gas since 2013, which is when we first started to produce separate forecasts for shale oil and gas in the Energy Outlook. And it's worth just pausing there for a moment. So we only started to produce separate forecasts for shale oil and tight gas 3 years ago. Which just reminds you just what an amazingly recent phenomena the US shale revolution is and how it's changed our energy market so rapidly in such a short state of time. And as you can see, if you look at the colours of those charts, we've been repeatedly surprised by the strength of US shale. Technological innovations and productivity gains have unlocked vast resources of tight oil and shale gas, causing us to revise our projections successively higher. And this year is no exception, with sizable upward revisions to the profiles for both tight oil and shale gas, shown here by the two green lines. Now, that may seem quite perplexing, given what's going on in the oil and gas markets at the moment, we're revising up our long-run outlook. For US tight oil, absolutely, the falls in investment and rig count over the past year mean that production is falling. It's currently around 500,000 barrels lower than peak levels seen last spring, and is likely to fall further through much of this year. But as the oil market gradually rebalances and prices eventually firm, we expect US tight oil to increase by almost 4 million barrels a day, stabilizing at around 8 million barrels and accounting for almost 40% of total US production. And the intuition here, when thinking about tight oil, the reason why it starts to plateau off, US tight oil starts to plateau off towards the end of the outlook, the constraint here is just the resource base for US tight oil is relatively small compared to gas. And so the constraint here is that resource base starts to limit the growth. And what we've learned over the last few years, both in terms of productivity improvements and also improvements in recovery rates, is that resource base is somewhat bigger, is increasingly bigger than we previously thought, which is why we're getting that line moving out. And so we've got stronger growth and the plateau moving further to the right. So that's what's underpinning that sort of upward revision. The resource base for US shale gas looks far greater than that for tight oil, such that US shale gas continues to go pretty rapidly throughout the outlook. There's no plateauing off for shale gas, averaging over 4% a year growth. By 2035, US shale gas accounts for around 3/4 of total US gas production and almost 20% of global output. And if you measure them in comparable units, US shale gas by 2035 is more than twice as big as US tight oil. So shale gas just enormously big. If we widen the lens to look at the global production of shale oil and gas, and outside the US, and look at shale oil and gas more generally, North American output, which is shown here by these quite excitingly green, luminous green. Interesting, when you do this in England, nowhere near as bright as, no, America has far brighter colours. Look at those green bars show you North American output, and you can see that dominates growth in the global production of tight oil and shale gas throughout the outlook. But production gradually diversifies. So in the final 10 years or so of the outlook, production from the rest of the world accounts for around half of the global increase of both tight oil and shale gas, with marked increases in China, Argentina, and Russia, amongst others. In the base case, global tight oil increases to around 10 million barrels a day, roughly double its current level. But again, in terms of those qualitative and quantitative things, that would still account for less than 10% of the oil market. So shale oil grows very substantially, but still only accounts for around 10% of the oil market by 2035. The role of shale gas is more pronounced, with its share in global gas production increasing from a little over 10% today to almost 25% by 2035. So the relative importance of shale gas quite a bit bigger. So this is a pretty upbeat story on tight oil and shale gas, despite the sort of current cyclical weaknesses we're seeing. And I'm also very conscious that we've been repeatedly surprised by the strength of the shale revolution. And so the question one should ask ourselves is, have we really learnt our lesson this time? What happens if we continue to be surprised? And to explore this possibility, we consider an alternative, stronger shale case in which global shale resources are assumed to be far greater than currently thought, and productivity is significantly higher than in the base case. The full details of this alternative case are described in the booklet, but just to give you a sense of how this might change the outlook, the dotted lines here show the revised market shares for tight oil and shale gas in this stronger shale case. Tight oil production is around 10 million barrels higher than in the base case. Some of this is at the expense of other types of oil production. So as shale oil expands and grows, that crowds out some types of other types of conventional oil production. But the other half, the rest of it, just over half the additional increase, is matched by higher demand. More plentiful supplies of oil means that prices will be lower than otherwise would be the case, generating its own demand. Likewise, shale gas is around 75 BCF a day, higher than in the base case, with shale gas in this alternative case accounting for more than a third of global gas production. So although this is not my central view, we do need to remember that we, and most others in the energy industry, have to date repeatedly underestimated the strength of the shale revolution. So this alternative case perhaps provides some food for thought in that context. Turn next to the issue of China's changing energy needs. At the risk of stating the obvious, China really matters for energy. It's the world's largest consumer of energy, accounting for almost a quarter of the world's total energy demand. And it's the world's largest growth market, accounting for almost 60% of the total increase in global energy consumption over the past decade. But as China's economy rebalances to a more sustainable path, its energy needs are likely to change, with potentially quite profound implications for global energy trends. In particular, we expect China's demand for energy, shown by the purple bars on the left here, to grow on average by less than 2% a year over the outlook, which is around a quarter of its rate over the past 15 years. Much of this reduction is driven by slower economic growth. China's GDP growth is projected to average around 5% per year over the next 20 years, which is around half the pace seen since sort of 2000 or so. But growth in China's energy demand is expected to slow by more than GDP. The growth rate of GDP halves, but the growth rate of energy is more like quarters. That partly reflects improving energy efficiency, but it also reflects a shifting pattern of economic growth within China, with growth shifting away from traditional heavy industrial sectors, which are highly energy intensive, towards more consumer-facing service sector growth, which requires far less energy. You need far less energy to give somebody a haircut or carry out a financial transaction than you need to produce heavy widgets, which you then send abroad. The most marked change from the past is China's coal consumption, which after years of strong growth as it fueled China's rapid industrialization, barely grows over the outlook and is declining towards the end. The sharp break in China's coal consumption is compounded by strengthening environmental policies aimed at encouraging a shift away from coal towards cleaner, lower carbon alternatives. And as you can see here in the chart on the right, as a result, China's reliance on coal falls sharply, with the share of coal in China's primary energy declining from around 2/3 today to less than 50% by 2035. And I must admit, so one of the privileges of this job is I get to travel around the world an awful lot. And one of the things I'm most struck about when I travel around the world is the enormous determination that you see being demonstrated in China to shift their fuel mix away from coal towards other alternative fuels. So really big shifts in the world's largest energy market over the next 20 years with profound implications for global trends. Turn finally to the prospects for renewables and other non-fossil fuels. This chart shows forecasts for renewable power over the past 5 energy outlooks. And as you can see, just as with US shale, we have repeatedly revised up our outlook for renewables, as we've been consistently surprised by faster than expected cost reductions and more rapid deployment, with this year posting the largest upward revision to date, reflecting both rapidly falling costs and the agreements reached in Paris. And as I said, renewables almost quadruple over the next 20 years, accounting for over a third of the growth in power generation. But the thing I found interesting when we were doing this analysis, when we were looking at this renewables and these revisions we've made to renewables, is that these repeated upward revisions to renewables have not led to significant revisions to the overall level of non-fossil fuels. In particular, the upward revision to renewables, shown by the orange bar, so this chart looks at comparisons of the current outlook with those in 2011, got significant upward revisions to renewables, shown by the orange bars, but they've been broadly offset by downward revisions to nuclear energy post-Fukushima and to biofuels, reflecting slower than expected technical progress on advanced biofuels. So the key takeaway for me from this chart is that just as with fossil fuels, the risks and uncertainties around the growth of non-fossil fuels are two-sided. We can overestimate the growth of non-fossil fuels as well as underestimate them. That's what I wanted to say on those sort of 3 key factors which were shaping the fuel mix over the next 20 years. What I wanted to do now is just briefly turn to just look at oil and gas, the outlook for oil and gas and natural gas in just a little bit more detail, starting first with oil. Now, I must admit, one of the real pleasures for me working on the energy outlook over the last few months is that every time my boss phoned me up and said, Spencer, what's going to happen to oil prices next week? What's going to happen to oil prices next month? I can say, sorry, I'd love to be able to help you, but I'm really focusing on the next 20 years. I haven't got time to think about what's going to happen next week or next month. And I'm going to try and hold on to that today and not start talking about the near term. But in very broad terms, the judgment which underlies our energy outlook, we obviously have to make a judgment of what's going on in terms of near term, how that's going to pan out, is that the market gradually rebalances over the next couple of years as the current low level of prices boost demands and dampen supply. So we're going through a cyclical downturn that may take several years to work through, but it's clear signs to me that the market is working like all markets. Oil prices is stimulating demand, it's dampening supply, and we should gradually move our way through this. Further out, we expect the global demand for liquids, and the demand is shown on the left-hand side here. And for here, I'm looking at total liquids demands, which includes biofuels and other liquid fuels as well as oil, to increase by around 20 million barrels a day to just over 110 million barrels a day by 2035. All of this increase in demand comes from emerging economies, with China and India accounting for over half of the increase. And this is matched on the supply side and the right-hand side here by an increase in both non-OPEC and OPEC production. All of the net increase in non-OPEC production comes from the Americas, led by the increase in US tight oil we were looking at a moment ago. In terms of OPEC behavior, which has obviously been the subject of considerable attention recently and even over the last couple of days, OPEC is assumed to act to maintain its market share at around 40%, increasing its production by around 7 million barrels a day. If we just switch back to the demand side a moment and just look a little bit more closely at the factors driving the increase in oil demand. Around 2/3 of the increase in oil consumption reflects higher transport demand, shown by that top light blue line, as the number of vehicles outside the OECD triples over the next 20 years. So the number of vehicles outside the OECD at the moment is around 500 million vehicles, and we think that will get close to around 1.5 billion vehicles over the next 20 years. And that's a simple story. As those economies grow, income levels grow, and as income per capita starts to get to key point, you start seeing vehicle ownership increasing. The impact of this increase in the global car fleet on fuel demand is offset to a large extent by gains in vehicle efficiency, which is assumed to improve even more rapidly than in the past. And it's really nice being in America because I can speak in terms of miles per gallon, which I understand. And when I do this in Europe, I have to start talking in kilometers and liters, and I get completely confused. But in terms of miles per gallon, which I find far easier, today, a typical car in the planet today does about 30 miles per gallon. Our assumptions underpinning this outlook is by 2035, a typical car in the car fleet in 2035 will do about 50 miles per gallon. So a really significant increase in car efficiency from around 30 miles per gallon to about 50 miles per gallon. So really significant gains. These efficiency gains are achieved by substantial improvements in the efficiency of the internal combustion engine, including far greater hybridization, smaller vehicle sizes, and more generally by improved vehicle design. So a key thing if you speak to car manufacturers is the use of lighter materials to build their cars as a way of improving vehicle efficiency. Importantly, the relative high cost of batteries means that the penetration of electricity within transport is projected to remain very limited over the outlook in our central case. Now, this is obviously open to considerable uncertainty as to the precise pace at which battery technology improves and is able to start really competing with oil in the transport sector. Our central view, which is based on the analysis set out in BP's technology outlook, so we have a sister outlook produced by our technology experts, which was published last year. It's available on pp.com and is a great read, thinking about sort of some of how the technology may change over the future, is that this is a sort of a when, not if story. So battery technology will be able to increasingly compete with internal combustion engine cars, but much of that is likely to happen beyond 2035. And a key point here when I'm thinking about a typical car in 2035, it roughly takes about 15 years for a car fleet to turn over. So in that sense, 20 years ahead is not that long. So if I want a typical car in 20 years to look very different, I need new car sales to change really quite rapidly to change that period. So it could, of course, come sooner, but our most likely case is we don't get a significant increase in penetration of electricity over the next 20 years, but that's an obvious caveat, and I hold my hand up to that caveat. If we turn next to natural gas, as I mentioned, gas is projected to be the fastest growing fossil fuel, growing at almost 2% a year. On the demand side, growth is supported by both gas gaining share relative to coal in the power sector, aided by both ample supplies and strengthening environmental policies, and is also helped by increasing use in industry as emerging economies industrialize. On the supply side, this increase in gas demand is met roughly evenly by increases in conventional production, with marked increases in the Middle East, China, and Russia, and the second source from that shale gas we were talking about earlier. So a really key feature of the gas outlook is a sharp increase in the global supplies of liquefied natural gas, LNG, which is expected to more than double over the outlook. Around 40% of this increase in LNG occurs over the next 5 years as a series of in-flight projects are completed, led by Australia and the US. So the roughly sort of quite mind-boggling fact, the way I think about this, is that equates roughly to a new LNG train, so a new LNG facility coming on stream every 8 weeks or so for the next 5 years. New LNG train every 8 weeks for the next 5 years. Now, if you're anything like me, whenever you see an economist stand up and make some great statement like that, you think, oh, come on. What's some fancy regression? What's the R squared on that? I can imagine. This is not some fancy econometric model or fancy econometric technique. This is a rather dull and boring exercise of sitting down with the accountants and adding up all the projects which we know are in train around the world. They've been FID'd, billions of dollars have already been invested in them, and we're pretty sure about where they're likely to roll out. So a real strong growth spurt as this market comes of age, which, as you can see in the chart on the right here, causes LNG to surpass pipeline gas as a dominant form of traded gas by the end of the outlook. And I think this potentially is really significant, and the significance comes from the fact that the greater ability of LNG to respond to price signals is likely to cause regional gas prices to become increasingly integrated over time. The point here, if I can see prices in one market are far higher than another, if I have a pipeline, I can't do anything about that. I can't pick up my pipeline and move it somewhere else. But if I've got liquefied natural gas on a vessel, if there's a big price, if there's a high price somewhere else, I can just tell that ship to turn right rather than left when it leaves the port, and I can bring about that arbitrage. If I go to our trading floor at BP, they have this neat little app where they can push a button and they can see all the oil vessels around the world and where they are, exactly where they are in the sea at any one point in time. And if there's a strong arbitrage relationship, they can go and then start trading that relationship. So the thing here is, if prices move too far apart, LNG supplies can be diverted, turn left rather than right, to pull them back into line. So the way I think about this is LNG acts like a glue, joining regionally segmented markets, causing them to move up increasingly in unison. So this story that we were all brought up of sort of regionally segmented markets starts to break down with this glue, causing them to move up and down together. So quite significant changes in pricing dynamics in global gas markets over the next few years. So that's what I wanted to say on oil and gas. And the final issue I wanted to touch on this morning is the outlook for carbon emissions, where the big picture message is the outlook for carbon emissions is changing very significantly relative to the past. And sort of what's going on here is shown in this next chart. So the way to read this chart is there's sort of two parallel periods, two parallel charts, one for the last 20 years and the other one for the next 20 years. And if you start from the left of both charts, you can see the growth of GDP over the outlook is broadly similar to the past 20 years. So those two orange bars have pretty even similar heights. But as we discussed earlier, energy intensity over the outlook, shown in purple, is expected to fall more quickly than in the past. Moreover, the shift in the fuel mix means that carbon intensity, so the amount of carbon which is emitted for each unit of energy used, which is shown here in turquoise, also falls far more decisively than in the past. The fact that it's almost a flat line, almost just a sort of single point line over the last 20 years, tells you there's been no material shift in the fuel mix towards lower carbon fuels over the last 20 years. We expect that to change over the next 20 years, or moving away from coal into gas, into renewables. As a result, the growth rate of carbon emissions, shown in grey, is expected to more than halve relative to the past 20 years, so less than 1% a year compared to over 2% seen in the past. Some of this break with the past was evident in previous outlooks, but it's more pronounced this year in the wake of the pledges and agreements made in Paris. That's the good news. The bad news is that despite the slowdown in growth, emissions are projected to grow, with the level of carbon emissions increasing by around 20% by 2035. The widening gap between the projected path for emissions and, for example, the IEA's 450 scenario, shown here in red, which is often used as a benchmark scenario consistent with achieving the 2 degrees C goal, illustrates the scale of the remaining challenge. And our central case, based on our best view of how policy is likely to evolve, we have carbon emissions rising by 20%, compared to the sort of 30% or so fall needed to achieve the Paris targets. So the central message from this outlook is that more policy action is likely to be required. And from an economics perspective, a meaningful global price for carbon is likely to be the most efficient mechanism for responding to this challenge. And the key thing about a global price for carbon, a pricing carbon, is it provides incentives for greater improvements on both sides. On the demand side, reducing energy intensity, and on the supply side, reducing the carbon intensity of the fuel mix. Those two things which were driving the reduction in carbon emissions over the future. In a more simple thing, even more intuitive if you like, we know from Economics 101, if you want to ration something, the best way of trying to ration something is you put a price on it. And that's what we're talking about here in terms of trying to ration carbon emissions. Now, this next chart provides an alternative way of illustrating what's going on. Now, I must admit, when my team first showed me this chart, I found it entirely confusing. But bear with me for a minute. I now understand it. And it's a neat chart, so if you can get your head around it, it's a neat chart to try and understand. So the chart looks at different combinations of average declines in energy intensity and carbon intensity. And if you remember, they were the two factors that we just saw in that previous chart, which is driving the slowdown in the growth of carbon emissions. And as you move from the top left to the bottom right of the diagram, signaling faster rates of decline in both energy intensity and carbon intensity, the average growth of carbon emissions declines. And as we just discussed, the average rates of decline projected in the base case are quite a bit faster than seen over the last 20 years. And you can see that by comparing the green dot with the history shown by the blue dot. We're moving in the right direction. We're moving towards the bottom right relative to history. But that still falls well short of those needed to get anywhere close to the IEA 450 scenario. You can just sort of see what a sea change you need relative to history to get close to that 450 scenario. It seems clear that we're in a transition to a lower carbon world. And a major uncertainty, if you've got the task that we have in terms of the economics team producing the energy outlook, is trying to think about the speed of that transition. How quickly will we transition to a lower carbon world? And to explore that uncertainty a little further, we consider an alternative case in which there's a faster transition to a lower carbon world, shown here. This faster transition case is based on a number of judgments, and we can go into them in more detail in the Q&A if people are interested. First, a carbon price rising to $100 per tonne in the OECD and in China, and at least $50 elsewhere, and $80 essentially in most of the large emerging economies. In transport, we assume there's tougher vehicle standards and other measures leading to smaller vehicles and reduced mileage. And we also assume there are measures in industry and buildings which drive significant gains in energy efficiency. So essentially we have a carbon price operating in the power sector and very significant legislation operating in the two other sectors. And as a result, both energy intensity and carbon intensity are projected to decline at historically unprecedented rates. Just see where that yellow dot is relative to history of the blue. Emissions peak in 2020, and by 2035 are almost 10% below their 2014 level. That still falls well short of the IEA 450 scenario, but goes well beyond the pledges contained in the Paris INDCs. In terms of the outlook for energy in this faster transition case, so what does the energy outlook, what does the energy landscape look like in this alternative case? Energy still grows, but around 2/3 of the rate in the base case. Non-fossil fuels supply all of the increase in energy. So if you remember, I said, remember that number. In the previous case, fossil fuels have provided 60% of the increase in energy, non-fossil fuels 40%. In this case, non-fossil fuels are providing over 100% of the increase in energy. Fossil fuels fall slightly, with their share in primary energy falling from around 86% today to around 70% by 2035. The main casualties you can see here in the black line on the left is coal, which falls sharply, hurt in particular by the high carbon price, causing it to lose share in the power sector. So that's where that carbon price really bites. The high price of carbon means the relative price of coal relative to gas and renewable increases very significantly and just causes coal to get really to lose share very dramatically in that sector. Renewables are the main beneficiary, with their share in primary energy increasing to 15% by 2035, compared with 9% in the base case. I showed somebody in London this and said, wow, and they went, really? 3 to 15? Doesn't sound that big to me. It's not that impressive. And I was trying to explain to this person, look, fuel shares are really slow moving. So if we put this in some sort of context, this increase in the share of renewables in the final 15 years of this alternative case is comparable to the gains made by oil in the period after 1908. This was a period which was the most significant period of where oil gained market share. In that period, after 1908, that coincided with the Texas oil boom, the discovery of oil in the Middle East, the British Navy switching away from coal to oil-based boats, and the Model T Ford starting mass motorization. Quite an amazing period for oil, and the penetration of renewables in this period would be the same. Again, one of those quantitative, qualitative things. That still only gets you renewables to 15% of the world's energy supplies. And it's worth noting that even in this scenario, the demand for oil and gas grows over the outlook. The red and green bars are still positive, albeit at much reduced rates. So hopefully this sheds some light on how the energy landscape might be affected if we were to move to a faster transition to a lower carbon environment than we think is the most likely case. Okay, I'm going to stop there and throw it open for questions. So let me just conclude. In concluding, I think I would highlight 3 key features of this year's outlook. First, as I said at the beginning, the global demand for energy is likely to increase markedly over the next 20 years as the world economy expands and more energy is required to power high levels of activity and rising living standards. Increase in energy enables that growth. Second, the fuel mix is likely to change significantly, with coal losing ground, renewables gaining, and oil and gas broadly holding their own. And finally, the outlook for carbon emissions is changing significantly, with emissions likely to grow far less quickly than in the past, but it's not changing quickly enough, suggesting the need for further policy action. Let me stop there.
Thank you, Spencer. And that was a lot, but it wasn't nearly everything in the packet. So I think you've accomplished your goal of getting people to want to go and look for more information in the Outlook. So I have some good news for you. We're not going to ask you about near-term oil price movements because we had like a 3-hour session here yesterday that Frank ran that solved that issue. So if you'd like to know what's going to happen near-term, you just tell Bob to watch that next time he has a question. But maybe what we'll do is I'm going to open up for questions in just a minute. And please, we've got several media outlets here and we are webcasting, so please wait for the microphone, state your name and affiliation and question in the form of a question if you could. I have a lot of questions. I'm going to start with a couple big ticket ones, okay? You ended on carbon price, so that's where I'm going to start. I think it's really interesting that you have an embedded carbon price in your outlook, right? And what you're saying is that there needs to be a much higher one along with some policy apparatus that goes with it to drive deeper carbon emission reduction over this period of time. What's sort of interesting is the form of that carbon price, right? So are you taking the position that that carbon price needs to be in the form of a carbon tax or a cap and trade? Or does it need to be some combination of policies that put together that sort of, have a carbon price equivalent, but are not an explicitly signaled carbon price? And one of the reasons why I ask is that now that we have some experience globally with carbon taxes, various, cap and trade systems in Europe, perhaps, we see that sometimes working out how those carbon prices interact with complementary policies isn't always sort of as straightforward as it was. So maybe if you could talk through how you thought about some of those dynamics in this carbon pricing recommendation that you've made.
And so to start with, one of the great benefits of a carbon price over legislation, and if you like, there's two ways of doing this. You put a price on something or you legislate. And when you legislate, it implies an implicit carbon price, but you're imposing it in particular sectors. The wonderful thing about a carbon price relative to legislation, it doesn't ask policymakers to pick winners and losers. So I used to be a policymaker. My previous life was a central bank, and I used to set monetary policy, rather than the committee that set monetary policy for the UK. And we used to set interest rates once a month. I found it hard to pick the right interest rate just for the next month. To ask policymakers to pick winners and losers, to try and work out what the right type of legislation is over the next 20 or 30 years, I think is an enormously difficult task. The wonderful thing about a carbon price is you don't have to guess how much of this will come on the demand side, how much of it on the supply side, how much renewables should we try and want to achieve in certain sectors or so on. We don't have to worry about that. You put a price on it and you let the market generate itself. And the market will find the most efficient solution, and it will adapt and change over time as technologies changes, our understanding of the world changes, and so on. So in that sense, a price has a huge benefit relative to legislation. In terms of a cap and trade versus a carbon tax, my own view is there is some economic differences between the two, but to a very large extent, they are the sort of the jewel of one another. My background's in monetary policy before I came to energy, and there's a sort of completely parallel debate and a parallel set of discussions about when setting monetary policy, should you do it by controlling interest rates or should you control it by the quantity of money? Mm-hmm. And there's a complete parallel literature which looks at the two things together. And there are some differences, and there's some very subtle differences when you start working, when you take account of the uncertain world which you're in. But to, I think, most economists, my own instinct is the differences between doing a cap and trade versus carbon pricing are relatively second order. And the most important thing is you find a way of achieving a price on carbon. And for some markets and some political structures, one would be better than the other, and for some it will be the other one. And to my mind, I'm pretty agnostic about which of those two it is. And in some sense, I think it's for individual governments to work out what's best. And that is because largely I don't think there are huge economic differences between the two. But there's a massive difference between setting a price and letting markets direct investments relative to setting legislation and telling people what the right way of doing things are.
Mm-hmm. So I said I wasn't going to ask you about near-term oil price fluctuation, but I did want to ask a little bit about how you talked about working in the OPEC share of your 20-year outlook for oil markets. This came up yesterday in the discussion we were having, and quite frankly, for folks who've been doing this a long time, figuring out what the OPEC share is going to be contributing to production has changed over a period of time. I believe you said that you work it in as assuming that OPEC is going to maintain its share, its market share.
Around 40%.
Yeah. You have any thoughts about taking a different approach?
Yeah, so I guess where I start from here is, so I have no idea why OPEC have behaved like they have over the last year or two. I wasn't sitting around the tables. I wasn't privy to those conversations. So I'm not going to pretend I know why they did it. But if I ask a different question, which is, from a purely economic perspective, what would I have done if I faced the issues they faced with? I would have behaved exactly the way they behaved. I think it makes exact economic rational sense of what they did. And it's entirely consistent with their behavior in the past. And at this point, people may be scratching their heads and going, no, it's not, it's completely different. But I think it is. I don't think it is, and let me explain why. OPEC, as a cartel, its power stems from its ability to shift supply from one period to another. So it has enormous power to respond to cyclical shocks, temporary shocks. If there's a temporary fall in demand, it can cut back supply today, knowing that tomorrow, as demand comes back on, it can bring that supply back on. Or if there's a supply outage somewhere, it can increase its supply until that outage is brought back on, that disruption is reduced, and then it can bring that supply, it can reduce its supply. So in response to temporary shocks, it has lots of power. In terms of permanent shocks, it has far more limited power because shifting one from one period to another doesn't make much difference if the whole market structure has changed. So to take an example, in 2008-9, as many of you know, oil prices, great financial crisis, huge recession. Oil market, oil demand fell very sharply. Oil prices fell from $145 to $35. OPEC quite rationally said, wow, look, this is a very significant demand shock, a temporary demand shock. I should pull back my supply to help stabilize the market. That's exactly what they did. Now do a thought experiment that we were in 2008-9, and exactly the same thing is happening to the oil market. Oil demand is falling very sharply. Prices have crashed from $145 to $35. But there's no financial crisis. But instead what had happened is one day we looked out the window and the world was just full of electric cars. They just fallen from the sky, and the world was full of electric cars. Exactly the same things happened to oil demand, fallen very sharply. Exactly the same things happened to the price of oil. At this point, OPEC goes, don't like this. I'm going to cut back my oil supply. I'm going to cut back my supply. Everybody else will go, cut back your supply. That'd be fantastic. The electric car will be here tomorrow and the next day and the day after that. If you cut back your supply, all that will mean is us high-cost producers can carry on producing. Please go ahead and do that. In response to that permanent shock, they can't do anything. And in some sense, what we saw over the last couple of years is not the mass penetration of electric vehicles, but what we saw is a new form of supply in terms of shale, which is a structural change to the market. That supply is not the marginal barrel in terms of the cost curve. It's somewhere in the middle of the cost curve. And it seems to me quite rationally that OPEC, in the response to that, did exactly what they should have done, which is say, look, I'm going to maintain my market share. And in some sense, if anybody's waging war on anybody, the real waging war is shale. As a result of shale going somewhere in the middle of the cost curve, some other high types of production have to fall off the end, which is exactly what we are seeing as firms cut their investment spending on sort of relatively high cost projects. So it seems to me what OPEC have done now is entirely rational. And in some sense, if you think about episodes of the past, 2008-9 and 98-99, the two most recent periods, were cyclical demand shocks, and so they responded in that way. This, what we're going through now, seems to me far more akin to the mid-1980s, where you had new supply come on stream. And how did OPEC respond then? Well, once they worked out how to do it after the early 80s, from the mid-80s onwards, they did exactly what they're doing now. And so this time, the OPEC just turned to the right playbook and played exactly the same in the past. And I think a lot of people were surprised, were essentially doing lazy economics, because they were saying, well, every time the price falls, OPEC cuts. You can't say that. You have to work out, why is the price falling? Is it a great financial crisis, or is it a new electric car? And depending on which one or two it is, OPEC will behave like it is. So my view is OPEC hasn't been surprising in terms of its behaviours over the past. It seems entirely rational. Its power hasn't changed in its ability to smooth temporary shocks. That still remains the same. And so I feel pretty comfortable assuming that going forward, it will carry on operating to maintain its market share. At this point, you're thinking, my God, don't answer every question that long. But that's the reason why we ended up with maintain its market share 40%.
That actually isn't what I was thinking. What I was going to say to folks who maybe don't know, and I'm not usually in the business of promoting other think tanks, but it's a good one. The Oxford Energy Institute published a piece that you wrote on the new economics of energy, right? That was it?
Yeah.
And it goes into that, plus your other thinking on what the structural changes are in the oil market. So I do commend it to folks. It is a very good piece.
In fact, actually, You don't have to look at Oxford Institute. You can look on bp.com, because
Oh, I'm
originally
sorry,
it was a
look at
BP
bp.com.
thing. So you can just...
Don't go to Oxford.
I would go, that's a far better website to get it from.
Sorry. Anyway, okay, I have a lot more questions, but I want to make sure we've got a great audience with lots of people who know their onions, so to speak. So I want to get to the audience. If anyone's got a question, please raise your hand. We'll take them with those ground rules, Ben.
Thanks, Sarah. Ben Schlesinger.
Ground rules.
Natural gas.
Microphone.
Is there a mic?
Thanks.
Hi, Ben Schlesinger. Thank you, Sarah. Natural gas consultant, I thought, anyway. And I'm getting to feel a little bit like Helen Thomas. I seem to have the first question 2 years in a row. Spencer, that was truly, truly interesting, and I really appreciate the multiple scenario approach. Have you developed a scenario involving very low battery price? Battery production is about to double this year. 125,000, I guess I just bought the 125,000th Tesla, traded it. So I guess, if things really start to move and battery production falls from 350 per kilowatt hour to 250, where it is sitting about now, down to 100 or less, what can you speak to that?
What would it look like? And the simple answer is that I haven't. And the reason why it's not my most likely case was the reasons I suggested. But it's a perfectly legitimate thing for us to have a think about. I mean, my instinct would be the overall demand for energy wouldn't be materially affected, because we've got very significant improvements in energy and vehicle efficiency here, but the fuel mix underpinning this would change. And obviously, in that world, the growth of oil would be less, and the growth of other fuels would be more. Not in this audience, but in some other audiences I speak to sometimes, they sort of forget that electricity doesn't just generate itself from the wall, that you actually need power to generate electricity. So then you have to ask the question, where does that power come from? And if you're then thinking, well, what's the implications for this for carbon emissions? Is this a good or bad news? You'd have to ask yourself quite carefully, because in many parts of the world, if this happened, this would be net bad for carbon emissions, because of the importance of coal in generating electricity you're putting in your vehicle, rather than oil. So ultimately, for many parts of the world, you'll be driving around in a coal-fired car rather than an oil-powered car. So they're the elements within it. So overall, not much impact in energy demand. Fuel mix, less oil, more others. Carbon emissions, question mark.
I've been viewing it as a natural gas-powered car, just so
yes.
Since natural gas sets the margin, and when you time the plug-in, you're actually firing up a natural gas-fired power plant somewhere. But that should be taken into consideration for sure.
Well, it depends on which parts of the world. In the US,
Right
obviously, in terms of mine was a global story,
Yes,
and in the global story, coal is still the most important fuel used in the power sector globally.
Thank you so much. I apologize, I've got to leave a little early. So.
Caitlin, right here in the front, and then we'll go to Bill.
Hi, I'm Tori Beek, an energy analyst at Oceana. I was wondering if you modeled any growth scenarios for carbon capture and storage, and what implications that might have for coal use in China and the developing world, or even here in the US. Thank you.
Yeah, so within our base case, carbon capture and storage is doing very little. Even by 2035, it's only playing a very small role. What's interesting in the faster transition case, when you've got that carbon price going up to $100 real, by the back end of the forecast, we're getting carbon capture and storage growing quite significantly. Still early days, but that's why sort of the second derivative of that carbon emissions thing is starting to increase. It's starting to come down more quickly. So because you're starting to get those economies of scale and that learning and so on. And so because it takes a while for the carbon price to get to $100, but at that thing, it's starting to have an impact. And so that's one of the mechanisms by which we're starting to get carbon emissions coming down in that faster transition case. And I haven't projected it further forward, but my instinct would be if I projected it forward a further 10 years, I'd get a disproportionate growth, because that's when I start getting that learning curve kicking in and I start getting those economies of scale. But so the difference between the two is that carbon price is allowing that sort of investment you need to start getting carbon capture and storage doing something.
Bill in the middle there. Bill, just stand up so Caitlin can see you. Thank you.
Bill Eichward, consultant. Could you walk us through on the shale expansion internationally, particularly a lot of growth in Asia Pacific, and what were your assumptions in terms of how that growth occurs, particularly given the difference in geologic basins and the experience?
So,
can I add one point to that too? Because I did think it was interesting. In the previous years, you and other forecasters have basically done sort of a optimistic shale, pessimistic shale. You've dropped the pessimistic shale. Is that sort of meant to be a vote of confidence in the learning of the last years?
So just to answer the second question, no. So I said why we produce this energy outlook primarily is to use it internally to help our thinking. And so the reason why we picked these three alternatives, and we've never sort of developed three full alternative cases before, and it's just sort of trying to evolve this process. The three alternative cases were global GDP is slower, so overall energy demand is slower. Secondly, shale has more momentum, so unconventional grows strongly relative to conventional. And the third is there's a faster transition to lower carbon, hurting fossil fuels versus to non-fossil fuels. The beauty of all those three is all three of them are really bad for big oil's portfolios. And so it was designed to think, how bad would they look like? And let's try and, prod internally and worry about it, and then worry what we should do about it to make sure we have a resilience. So that's what it was designed to do, to spark interesting conversations at home. You can tell I'm a very popular person at home. And so that was what was designed. In terms of how we, what was underpinning the outlook, I'm just going to try, Armene will correct me when I get this wrong. So what we did here, we increased the presumed scale of the resource base by 50% for tight oil and 30% for gas in the US, and 100% and 50% for gas and oil in the rest of the world. So big increases in the resource base. We also assumed that the level of productivity by the end of the outlook throughout the world was 20% higher than in the base case, and then just try to map that through. In terms of and so we're just trying to get a sort of ballpark estimate. And then, as I was saying, there's a little bit more in the outlook. On the oil side, the main issue was how much gets crowded out. So one is what does the production look like? And we got that tight oil coming in, as I said, across a whole range of different countries. The ones we highlighted, some in Russia, some in China, some in Argentina. The issue then is how much of that is likely to crowd out conventionals and how much of it is likely to cause demand to fall and then to meet its own demand. And the other component there, in terms of the crowding out, how would OPEC behave? And so what we assumed is OPEC, because I have this sort of way of the world thinking that OPEC behave rationally, then in that world, OPEC, in response to a shock like this, they maintain that market share. So all of that crowding out happens in non-OPEC supplies, and we try and sort of pick some of the higher cost basins. But at this point, our level of doing this in great detail gets a bit fuzzy. So we just sort of intuitively, or there's a sort of, we have a sense about which ones, but we don't sort of identify them in particular. On the gas side, it's even more interesting because not only do you have to think about the trade-off between conventional gas and shale gas, you also now, because of the ability to gas to compete against other fuels, some of the impact here is crowding out less conventional gas, but also it's crowding out coal and it's crowding out renewables in the power sector because it's able to compete a little bit more. And again, we have shale gas coming on there in some in China coming through more than before, Africa, Algiers coming through, and a little bit more in Russia as well, in terms of the sort of geographical pattern. But what's different between gas and oil is oil has to either absorb, because of its ability to compete elsewhere, it either has to absorb it or crowd out other types of oil. Gas can actually just gain share from other fuels because of its ability to do so in the power sector. And that was a sort of thought experiments we were doing when going through that scenario.
Warren Wilczewski, Energy Information Administration. Spencer, I was hoping you'd maybe be able to parse out a little bit more the supply and demand picture for liquids. You had a couple of slides where you have oil and liquids being used interchangeably, but my understanding is that in your outlook and in our outlook, NGLs grow faster than traditional crude resources. And I was hoping you could maybe speak to how BP sees that playing out. Thank you.
Yeah, so I'm going to phone a friend at this point who's in the front. Can you? So of that 20 million barrels a day, do you have at the top of your head NGLs? I got like a 5 or 6 number in my head, but I'm not sure if that's about 5 or so. About 5 or 6 of that is NGLs coming through. We think, and our ability to decompose this is not much, but we think the vast majority of that increase in NGLs is likely to be associated with US shale. So that's where it's sort of as an associated thing coming through. The other thing, so the vast majority is coming into transport demand on the demand side. The other thing where those NGLs are obviously naturally going to is in sort of petchems as well. So there's so that's quite an important sort of source of demand growth. It's sort of the second most important demand growth industry in petchems. And a part of that, which is sort of an obvious point once you think about it, but I hadn't thought about it, so I thought it was interesting when somebody pointed out, of that 20 million barrels a day increase in liquid fuels, we think roughly about 5 million barrels of it is used for purposes where it's not combusted. So either in petchems or in lubes or in bitumen. What's important about that is when you think about how oil will be affected by a carbon price, a quarter of it is not combusted and so doesn't give off carbon emissions. And it's really easy to think every time I use oil, that clearly must be giving off carbon emissions, but around a quarter of the increase we have is in things which don't actually generate any carbon emissions. And our number of a quarter is our nature of the way we set this up is we had to sort of, there's a slight degree of hand waving there, but we think a quarter sounds about right. We've spoke to some other forecasters who are a bit more sophisticated than we are on this, and they've actually got even a bigger number. I know some others would say about a third of their oil increase in oil demand is sort of non-combusted. And so it's just important when we're thinking about how the world is likely to be affected by sort of higher carbon pricing in one form or another. It's important to remember that a significant increase of this oil is in forms which is not used, and NGLs are the sort of the classic sort of and the natural feedstock for a lot of that industry.
One more question. Here you go.
Thank you. Henry Newsom, Secor Holdings. Thanks very much for the presentation. Has BP analyzed its prior outlooks in comparison to the relevant projection periods that are now recent history? And how is it, if it's done such an assessment, how has it fared? Where has it succeeded? Where has it failed? And that would be a more interesting, I don't know how long BP's been doing these. If it's been doing these for 15 or 20 years, that would be much more interesting if it's only been done for 5 years.
So, missed the first bit of the question. Is it relative to other outlooks, your question?
No.
Or just ourselves?
Prior outlooks.
Yes, okay.
How they compare to the relevant projection period that is now.
Yeah, and so
in a 1995 outlook, look into.
Yeah, and so we've only been publishing these for about 6 years, and so that's why I showed you a number of charts over this 6-year period. And so we have this interesting one where we, in some sense, have been systematically underestimating renewables, but not non-fossil fuels generally. Then I showed you that shale story, which was we have been systematically underestimating, and I think that's interesting. I think the third one, there's a sort of section in the booklet looking at changes over a 5-year period, talking about it. It's interesting. I'm going to get told off doing this in public, but what the hell. When I said to my boss, we're going to show all these charts showing how we've got things wrong, and he said, why on earth are you showing people what we got things wrong? And the point is, that's how you learn. And that's how you stop making errors, by thinking about what's the signal here and how do you think about it. The third one, which we do here, and it's a sort of challenge to ourselves, is we have made systematic surprises. The growth of gas demand over the last few years has repeatedly come in weaker than we expected. And so the question is, does this provide a challenge to our view that this is sort of the next 20 years of the golden age of gas? And we include some analysis in there. And the punchline is, the central judgment we've made here is the signal about the recent outturns has very little signal for the future. So what we do is sort of revise down the profile for the level of gas in a sort of parallel line. We build in the lower starting point, but then have that same growth rate. Now, as a forecaster, I always get nervous when you think there's no signal. Now, we put some analysis in the book which explains that we think the factors which have driven these slow outturns are essentially cyclical and are not related to the sort of the fundamental drivers over the longer term, which is the fall in price of gas and this sort of growth of gas demand, particular in Asia. But the reason for including it in the book and sort of thinking about it was to sort of say, we could be wrong here. There may be a signal in that. So there's quite a bit. They're the sort of three bits. There's some other bits as you go through. And it seems to me, just in terms of how one should think about a forecasting process, continuously looking in a very open and transparent way of how have we turned out differently from the past, what signals should we learn from the past, seems to me just what good practice should be in terms of trying to make sure that you're trying to learn as much as from the past for the future.
And I think it's a great point. EIA, Howard Grunspecht was here yesterday, did the same thing, showing how they were sort of consistently overestimating demand. And Fatih Birol, the head of the International Energy Agency, was getting very similar questions about consistently underestimating renewables. And I think that what's been interesting is that you're seeing a lot more aggressive penetration of renewables in a lot of these different outlooks. The one thing I kind of wanted to ask you about that part of this outlook, because you are thinking about it quite deeply, you have much more aggressive sort of renewables numbers this time around. Do you fundamentally think about levelized cost of energy for renewables and power generation and sort of and that sort of thing? Or maybe in your deep decarbonization or your carbon scenario, what's the barrier to even greater penetration in that? Is it the cost comparison itself, or is it the infrastructure of sort of integrating it?
It's sort of, again, the best source for this is less our energy outlook and more the technology outlook, because the technology outlook talks about this in quite a lot of detail, and again, we then just sort of take that and plug it into our thing. Where, to my mind, there's sort of two constraints. One is, for renewables to grow as much as we've got them growing, they have to be able to stand on their own 2 feet and not be able to be subsidised. And because in some sense there's a fiscal ceiling, it's easy to subsidise something when they're very small, but as they grow over time, that fiscal burden will increase and increase. And so, for them to grow to the extent we are this quadrupling, that's only possible if that sort of subsidies can be taken away and they can stand on their own 2 feet, which is what we've got built into this forecast. And we've got very significant sort of learning curves for both solar and wind. Solar's steeper than for wind built in, which means by 2035, increasingly both wind and solar is able to compete against oil and coal in the power sector. The other constraint is, once you get to sort of levels of 30% or so penetration in the power sector, then the intermittency problem becomes a real significant problem and issue. And we try and model that by trying to take account of what the additional cost would be once you get to those levels. And so, for example, in the outlook, in the central case, we have renewables getting to that sort of levels in the EU, and that acts as a constraint, dampening that growth, because suddenly the cost of taking it further becomes significantly more because you need to deal with that. So the analysis and the modelling of the numbers we take from the technology outlook, but trying to take into account that as you get to those high levels, you'll then have to deal with this sort of intermittency problem, the infrastructure problem in a bigger way. Acting as a constraint is built into the sort of the trends we're showing here.
Well, listen, I know there's a lot more questions. We have promised to get Spencer out on time today. I just wanted to say thank you for coming by, but also commend you and your team, you, Mark, and Omni, and everybody else that works on this. I think that adding the 3 sort of scenarios, it's really sort of, deepened the analysis, and it's always been a helpful document, but I think it is even more so this year. So congratulations.
Thank you very much.
Thanks
Thank
very
you very
much.
much.